Welcome to this Killik Explains finance video. Just going to give you an update on a key video that some of you may have seen before, but it's gone a little bit out of date. So here is the 2019 stock market cycles and why diversification matters. Okay, in a nutshell, what are we looking at here? There are two types of risk. When you buy equities, and we're looking at long-term investments here, one is called single stock. And that is what you can manage through a process called diversification, not putting all your eggs in one basket. There is another though, market risk. And that's the idea the market might actually collapse on you. Diversification won't save you from that, but the right approach potentially will. So I'm going to cover both. Single stock risk and the power of diversification, market risk and the power of not doing something daft. Okay. Now, single stock risk is what? You might look at something like Amazon, and people do this all the time. They say, I wish I'd bought Amazon 10 years ago. Wow, I'd be so well off if I'd done that. Hindsight's a wonderful thing, and buying single stocks looks with hindsight like a tremendous idea. Put all your money into Amazon, and look how well you could have done. But that's because I'm showing you the Amazon graph. If I were to pick another big, once highly successful company, you get a different picture. There's Killik with a graph that looks rather different and ends in tiers on the right hand side. If you put all your money into that basket, you would now be weeping into the same basket. So here's the point. You want that, you might get that. So what is the right approach to investing? It's not to gamble on whether Amazon or Killik is going to make you a fortune quickly. No, it is to diversify. So why are we doing this? Basically, diversification is the idea of not putting all your eggs in one basket. That's the old cliche, if you like, spread it around. But then people start to say, well, how much spreading do I need to do? We're coming to that. No firm is immune from trouble, that's the point. Hopefully, Amazon will continue its climb in the corporate world, but who knows? BP's come a cropper in the past. Firms like Tesco, G4S have all hit trouble when people said they couldn't possibly fail and all the rest of it. So be aware that any company can hit problems with its dividends, with its growth and so on. Backing single stocks is therefore effectively gambling, if that's all you do, and by spreading your risk, you reduce it. Now, the next obvious question then is, well, how do I do that? So how much spreading of risk, so how many more shares do I need to buy? If I've got to do to get this right? Well, it depends. There are various ways you can diversify. You can do it by sector. You can do it by geography, but spreading your money around the world. It's really important these days to have exposure not just to UK companies, but to overseas stocks as well. And then, of course, there's by theme, whether that theme is healthcare, whether it's emerging markets and the themes that underpin that, demographics and so on, whether it's one of the technology themes. That's a really important way to make sure that your portfolio is spread over a number of key ideas and giving you the most chance of capitalizing when those ideas come good. Now, people still say, well, how many stocks is that then? And the answer is it doesn't have to be loads. Now, opinion divides on this. All right, there is no right answer to how many stocks you should hold. Some people hold more than others. But capital asset pricing market theory on single stock risk, and if you're thinking, crikey, where's he going now? To summarize, what this graph is trying to say is along the bottom, you've got the number of stocks you might be holding from sort of 0 up to like more or less 50, if you like. And up here, you've got the percentage of remaining single stock risk. And really what this model is saying, and not everyone follows it to the letter, is somewhere around the kind of 15 to 20 mark, your single stock risk for holding lots of other stocks almost disappears. It's never going to completely disappear, but it certainly is substantially reduced. So suddenly, we're not looking at holding hundreds of stocks, a much smaller number might do you quite nicely. Now, this you will barely be able to read. I guarantee that, but this is just to try and make the point. I'm going to blow up part of it in a moment. Imagine you were investing, let's say £80,000 in 16 lots. So you've picked 16. Now this is not a recommendation, this is not advice, but let's just say hypothetically you thought July 2014, I will put £5,000 into 16 stocks, making, if you can read it, which you may not be able to, 80,000 at the bottom. Apologies for the fact this is a bit of a busy slide. Where would you be in July 2019? And these are all household names, Lloyds, National Grid, Prudential's there, AstraZeneca, spread of companies from a range of different sectors. This is not a recommendation. I'm not saying you should do this today. I'm not saying you had to do this back in 2014, just to make the point. Where would you be now? And I'll blow this up in a moment. So here are the prices if you like, the value of those holdings, those £5,000 holdings today. Some of them have gone up, some of them have done really well, some have not done so well, and that tends to be life with stocks. But if I just blow up now that bottom line, and by the way, this is an evenly weighted portfolio. We're not being held hostage to market capitalization like some indices are, so we end up holding loads of the biggest stocks. We've done it evenly weighted. We've picked a range of sectors. Some have done well, some haven't. And this is with the benefit of hindsight, of course, which in practice you don't have. Nonetheless, blow this up, and what you find is, okay, there is the original £80,000. It's become, within the portfolio, around 93 over that 5-year period, the last 5 years, versus the FTSE 100, which has climbed from 80 to 88. So basically you've done fine. You've actually done a bit better than the broader market. I should stress that the portfolio was simply picked for illustration. Again, you've done it with 16 stocks. Now, is 16 the magic number? No, but it makes the point. You don't necessarily have to hold the whole market in order to get the diversification effect. Okay, I'll move on because I'm aware that's not the easiest example to read. What about market risk? So let's say you're thinking, right, I'm going to diversify, I get it. If the market crashes, be careful. And it can. Here are some examples. The worst one was the early 1970s, and we'll go back to that in a moment, when the market lost 2/3 of its value. That's the UK stock market in a very short space of time. Pretty scary, and because it's the big one, we'll go back there. Long time ago, but the biggest one. But we've seen others where it's gone down 1/3, 1/5, dot-com crash, 50%, last credit crisis, 50%. These are big drops in the market and pretty scary. There's no point in me telling you they're not scary, because they certainly are. Now, diversification won't protect you because everything drops together, all right? So the question is, what do you do about it? And you take the right approach is the right answer. Now, what do I mean by saying the right approach? What is that? Well, let's look at the FTSE All-Share. Now, I could have picked an international index, and many people would say I should, but let's stick with the FTSE All-Share. That's the big index of UK shares. Let's look at cash, and let's take a £25,000 investment. Why 25,000? Doesn't really matter. It's the principal more than the amount as our initial investment. Let's say you went into the market in shares at the worst possible time, the start of the 1970s. I know it's a long time ago, but this was a monster crash, versus somebody who's playing it safe in cash. Where would you be just a few years later? The answer is the person in cash has their £25,000 plus a bit of interest, hopefully, still sitting there. The person in equities looks to be in all sorts of trouble. Basically, their money's been almost wiped out. You've lost 2/3 of it. Now, here's my point. If you were to panic at that point and dump your stocks, or put yourself in a position where you had to sell, because this is your retirement date or something over here, or you need to buy a house, you liquidate. If you liquidate for any reason there, you probably never went back to the stock market and went, stocks are rubbish. But that would be precisely the wrong thing to do. Because wind forward, here's a big chart, and you get this effect. Now, that what you were looking at just there is now squashed in here. Right, there's that little dip where stocks underperform cash. Wind forward to today and look at the gap between stocks and cash. Someone who stayed in stocks has done incredibly well. And that assumes they invested at the worst possible moment at the start of the 1970s, let alone one of the better subsequent moments. And what you see is the market had already recovered and then went on to bigger and better things. Now, it went in a wobbly line. The cash line's nice and flat, all right? This line is all over the place. So there's some big wobbles, but here's my point. You don't panic sell. You don't put yourself in a position where you've got to sell. You stay invested, and if you do that, things look okay. Now, people have said to me, well, what are you comparing here? Capital only market growth from equities with cash. Well, what about if you inflation adjust it? Because isn't the important thing whether you're making real returns, whether you're actually getting wealthier in terms of what you can buy, what's called purchasing power? Well, the chart looks like this. Now, it looks a bit different, but it starts in the same place. It ends in the same place. This time, the red line, the pink line, the cash has gone from 25,000 down to a 1806. Now, you might be thinking, well, hang on a minute, how can that happen? Surely it looks like 25,000 when you pull it out the top drawer. Yes, but what it buys is only just under £2,000 because of inflation. And people don't realise that. That's the pernicious effect of inflation, the silent killer of returns. Whereas your £25,000 in equities is a more respectable 35,000. You've made a fairly dramatic increase in your purchasing power. The numbers are less important than the principle in a way. And compared to cash, you've got a substantially bigger ability to buy stuff at the end than you had before. Okay, so then people, and we won't keep doing this because you get a bit bored, people say, what about total returns? What about the fact that cash generates income, but shares can generate income? What about if you take that into effect? Good question, because the best way to succeed in long-term investing is to reinvest your income. Don't keep pulling out and spending it. Let it roll. Let it get reinvested. And there are easy ways to do that. Then it looks like this. Now you might think, how exciting is this? We'll look at the numbers on the right now. So reinvesting income, this is taking data from the Barclays Equity Gilt study. You've got a decent £500,000 off 25,000. You might be thinking, how's that work? Well, it's right back here, long time ago. Power of compounding and so on. But compared to equities, still not as spectacular. You've got around 3 million, just over 3 million in equities as a result of compounding total returns. That's not just capital, it's also reinvesting dividends into shares. So whichever way you cut this, the long-term picture, past no guide to the future, not guaranteed, I know that, but the long-term picture looks pretty good. So, managing market cycles means what? We'll finish off here. Basically, get your approach right. So, diversification will protect you from single stock risk, but when markets fail, you need to have the right approach. Avoid panic selling, avoid forced selling. Finish on a word about that in a moment. Reinvest income if you can. These are like rules of thumb. And recognise, as you saw from my previous graphs, that dips don't last forever. The market tends to dip sharply and it often tends to recover quite sharply, the so-called classic V shape. And if you know that and you're prepared for it, it doesn't need to catch you out. Now, what does planning mean? It's a bit of a, what do I mean plan well? Well, basically, we have an approach that suggests identify your rainy day funds, cover that in more videos. Make sure you've got the short term secure. Then look ahead to those foreseeable calls on capital, those things you'll need to pay for, where you can estimate the amount and the timing and have a go at working out how much you need, and let the rest of your wealth and your family's wealth accumulate decent purchasing power increases as lifetime savings. Again, you can look at this from a family perspective as well as an individual perspective. And that's the approach that's most likely to give you decent increases in long-term purchasing power. Any questions, editor@killik.com. And if you want to watch videos on some of the things I've just hinted at here, then killik.com/learn. Check out the tab over here and either go for the shares section or the investing principles section.